today is Paul Welch, the CEO of Buccaneer Energy, after the company has raised £600,000, about 800,000 US, with the intention to drill 2 new wells and to include some Bitcoin mining as well. Well, Paul, thank you for joining us as always. How are you?
I'm great. Thanks for having me today. Wonderful to talk to you.
Yeah, good to be speaking. It has been a little while, but it's good to see that you've now got some serious plans to drill those Fouke wells, as of course you've been aiming for a while. But just first of all, on the placing here, how was it supported by investors, the market, and importantly as well by existing shareholders who will have been diluted circa 40-50%? I'm thinking here the Premier Mitons of the world.
So our biggest shareholder, Premier Miton, stood their ground. So they're still an 18 plus or minus % shareholder. We had, management participated. All of our institutional investors participated. So it was, I think it was very well supported, and people understood what we were trying to do with it. So I don't think really anybody's going to get too diluted in this from our main shareholder base.
Good. Okay. Good. So the plan is to drill 2 new wells, and so the first one to be Fouke 3. This will be in September, and then the second one at the end of the year in December. And you've got about 30% of that. So 30%. You're fully funded for both those drills at the moment.
Correct. Yeah, we are. So I think the first one we're targeting kind of late September, early October. It'll depend. We had some land issues we have to work out, and then the second one will be in December. We would ideally like to do them back to back. Our partner is a little more cautious on that, so they want to have some time to have a look at it and see what we got, and then plan the 4 well. So we're looking at let's say late September, early October, and then December, with the first well being on in October and the second well being on in January. That's what we expect.
Right. Okay. So you'll be hitting the new year effectively with a lot of increased barrels of oil.
Yeah. So we expect both these wells to come in at the field allowable rate, which is 124 barrels a day. So we'd add 250 barrels a day gross, and we have a third of that. So about 80 barrels a day net to us we would get from this campaign.
Yeah. Okay.
And
so at the moment you go on.
So I say the good thing about these wells is I'm sure we mentioned in the past is that we don't make any water here. We just have them on pumping units, and so our operating costs in this area are less than $5 a barrel. So no matter what the oil price is, we have positive cash flow from these wells all the way down to $10 a barrel, which I never want to see again. But if the oil price does dip, which some people are expecting in the late fourth quarter, these are very, very profitable wells from an IRR perspective. They make IRRs above 100% or above 200%, and then payout time is about 6 months. So these are really good opportunities.
Cool. Good. Well, I like to sort of go over the numbers. So at the moment, I understand you're about 130 barrels of oil per day. All those workovers are complete. I'm basing these numbers on about $70 WTI, which is a little bit higher than where we are now, but I'm basing it on 70. So that gives you at the moment a revenue circa of 2.4 million US per year, 1.8 million pounds, a free cash flow of about 1 million. I've sort of just taken off about 800,000 there for your general costs that come into it on running a PLC, etc. So does that set the scene at the moment? That sound about right?
That sounds about right. I think we're running our budget slightly lower price. We're running around $60 a barrel, so take about 10% off that. I think we're right in the ballpark though. Yeah.
Okay. And then as we get those 2 wells online, you'll increase then to a total of 210 barrels of oil per day. So revenue there circa of 3.8 million US, 2.8 million pounds. So that's a 58% increase from sort of where you are at the moment. You do have the Bitcoin element. I'm not going to include that because it's not zero, but we don't know what the number is. And I do want to ask a question on that in a moment. But that effectively, if I've got those numbers roughly right, a free cash flow throughout the course of 2026, just on what's been announced now, of about £2 million.
That's about right. That's correct. Assuming no significant change in the oil price. Yeah, I think you're spot on.
Yeah, sure. Right. Sure. Okay. The Bitcoin element then, that's interesting. Just tell us a little bit about that. Is this just an easy way to sort of use gas that would otherwise be just vented or burnt and actually try and make some money from it, or even to build a little pool of capital there?
Well, it's probably a combination of the two. The issue we have in the Fouke area is that as we produce these wells, the reservoir pressure has dropped. So as the pressures drop, the amount of gas, say, per barrel that we produce has increased. And so in the Fouke 1, we've essentially taken some of the back pressure off the well from the gas and vented it to the storage tanks, which are next door to it. In the case of the Fouke 2, we couldn't do that. So we're bucking some pressure to produce that well. So when we look at the individual production rates for the 1 and the 2, the 1 well is making like 65 barrels a day, and the 2 is making 35 barrels a day. And that's a direct result of the amount of back pressure we're bucking there. With the Fouke 3 and 4 coming online, we expect more gas. And so we were going to have, what are we going to do with it? Because in the Pine Mills field proper, we have very little to no gas, right? And so we're looking for a solution. A pipeline wasn't feasible because the gas volumes are kind of like 200 MCF a day. So the solution, which is happening kind of all over Texas at the moment, is to, put in a small Bitcoin mine, generate power, use that power to mine for Bitcoin and get some revenue that way. So whether we get the revenue through Bitcoin or through a gas sales agreement from a Bitcoin miner is to be determined. But it's a way to not vent the gas, potentially make some decent revenue from that gas stream that would otherwise be lost. And so it's just an opportunity that presented itself, and we think it was a good way to do it. So we don't increase our flaring. We have very little flaring as it is, and we have the potential to make some decent money from it. Now, what Bitcoin does from a price perspective is kind of up to the speculators, but it's certainly better than zero. And the cost and the complexity of adding a Bitcoin mine for us is nothing because we're already running generators in the field. We have a crew there, 24/7, keep an eye on operations. So, the Bitcoin element is essentially just adding a stack of PCs to a generator that's been pumping out power. So it's not a big deal to the operation. And we're in a part of the world that is very easy to add a couple of containers. So it's something that really fit well, and it allows us basically not to vent the gas and produce the wells at the highest possible rate that they can produce at. So that's really what drove us to the Bitcoin plan. A lot of people have jumped on the Bitcoin thing with Bitcoin Treasury, Bitcoin this, Bitcoin that. We're an E&P company. We're going to be generating some cash from Bitcoin, but we're always going to be E&P. We have no desire to change our spots on that. It's just another additional revenue stream that's kind of uncorrelated to the oil price, which we think is important. So it's just a way to generate some additional cash.
Okay, excellent. Well, I just want to ask a question to finish off just on the general. We sort of know the strategy. You have that big 5,000 barrels of oil target that you've mentioned before. You're obviously a fair way away from that.
Yeah.
Cost of capital, it's not cheap at the moment. Of course, the market cap of the company is still fairly low, considering you've got that, or you will go into that free cash flow of $2 million, all being well, throughout the course of next year. Companies, investors like Premier Miton clearly saw value a year ago, I think, when they first invested. And yet the sort of value still isn't really being built into the share price, which then, of course, costs you on dilution when you need to raise funds to indeed build value. So, what can you do to get that market cap up? Are you looking at? Do you think this will help with the increased cash flow? Are you looking at mergers and acquisitions? What sort of things are we thinking here to get that value up so that you can then go and raise more in the future with less dilution to then get that exponential curve going on production?
So it's kind of if this was a multiple choice question, it's kind of all of the above, right? So we look to
there's a few bits in there.
The first thing is we have to deliver these wells. So adding 250 barrels a day gross to the story is super helpful because that's 80 barrels a day net, a very profitable barrel. So assuming if we use your oil price, at $70 a barrel, it costs us about $5. So we're making $65 per barrel in profit. From $80 a barrel, from 80 barrels a day, that's a lot, right? So that's a big chunk of revenue. We need to promote that, let people know that we're generating cash. We're cash flow positive. We are looking for acquisitions out there. It'll depend on what the oil price does, but there are people that are selling things. We've been active in the market looking for opportunities, and we just need to get out and promote the story. I think a lot of it is just we haven't told people what we're doing. We need to really generate, some positive momentum from this point. And that's what we intend to do, just to really communicate, what our plans are and what we're seeing out there. But also success. We got to make sure these wells work. And then, we need to grow the production. So I think we've done almost everything we can in the Pine Mills field. There's probably a few more workovers that we can do, but 100 and 150, 160 barrels a day is probably where we can top out. Adding some additional volumes in from these Fouke wells, additional Fouke wells is certainly going to help. But the Fouke reservoir is limited size, so I don't think there's another well there. But that remains to be seen. We'll see these first two go.
Right.
So beyond that, we have to scale. So other things we're looking at is improving essentially the response of the water flood. So there's some bioremediation things we're looking at putting microbes down the well and see if we can increase our production from that. So we're looking at some technical solutions to see if we can increase the amount of production we get out of individual wells in the field. And then we're looking for opportunities around that. There's lots of opportunities in East and West Texas. And so, as those things become up and become available, we're gonna take advantage of them where we can.
Okay.
So kind of all of the above is the answer. Because to get to the 5K a day number, we're going to have to do everything. We're going to have to increase our production organically, maximize the potential from these water floods that we have, and then add bolt-on acquisitions in and around the area. Again, we want to kind of stick to onshore Texas. That's kind of our sweet spot. We like the operating costs. We understand the environment. We don't intend to look, anywhere else beyond that at the present time. I mean, again, maybe Louisiana, other places like that potentially, but in that general area, we don't want to. We're not intending on going overseas or anything at this point. So it's just kind of basic blocking, tackling. Our operating, our costs are low. We have good infrastructure in place, so it's easy to add on, bolt-on type small acquisitions and start to grow it there. So that's the plan.
Okay. I'm just thinking, was there a deal, were you involved with potentially with 88 Energy? Their partner took it in the end, but I seem to have read that maybe you were involved.
That's one of those things that you can't make comments on deals that you don't close. So I'll just leave it that I think that the 88 Energy deal for the partner that took it was a good one, and we'll leave it.
Okay.
So.
Okay, fair enough. But is that kind of deal something that you would look to achieve? I'm just thinking when you talk. Yeah, right. Okay. I'm just thinking, is what you're doing, is it exciting enough? You sort of said that Pine Mills is pretty much done. Fouke is possibly done after these two wells. What can make it more exciting? A big acquisition or drilling, big risky things that might be a huge gush?
Well, I don't know. I don't think we're going to do that. I mean, again, when I say that Pine Mills is done, I want to completely exclude it. In Pine Mills, we've got essentially 4 reservoir horizons that are all productive. There is some deeper potential there that we really haven't explored, I would say, in great depth. We have wells that go down there and touch it, to penetrate it. So there are also behind pipe things. Just
sure.
The immediate, wells that we could return to production. Essentially, we've done that. Now it's going to be more, as I've said in the past, more looking at, we have an existing well that's in, the sub-Clarksville. Can we go to the Woodbine, or can we go to a deeper horizon, the Biloxi? Those are the type of things that we'll need to do in the field to maximize its potential. So we're looking at that. Looking at, again, increasing the efficiency of the flood with some biocide that we put into it. So there's a number of things we're doing there, but then also, acquiring things in and around the area where we can, keep our existing infrastructure, add a little bit of additional production to it, but the cost base doesn't increase. Those are the kind of things that will help us really generate cash flow. Because 5,000 barrels a day is, kind of the target from a number perspective, because it's easy to quantify, but it's really a cash flow thing. You want to add barrels that generate cash. So we're in the business to produce money, not necessarily to produce barrels. And so that's kind of the key. So it has to be the right kind of asset that generates cash on an ongoing per barrel basis that's similar to what our existing assets do. So that's what we're looking for. And again, a lot of these are going to need some help. They're going to be deals that haven't been invested in for quite some time. That the drop off in price from $100 a barrel down to 50, 60, where we were a month or so ago, really hurt a lot of people, including ourselves. And so we bounced back. We think we've got a good solid story here. Some people haven't. Some people have a lot of debt and that sort of thing, and so they need to sell. So those are the type of things we're looking at.
Okay. Well, Paul, thank you very much for joining us. So maybe we can catch up again when you do indeed spud that well, if there's no news before then.
Well, I think it's a good idea. I think what we'll do when we spud that well, we'll have you have you guys on location. We'll have our camera on location so you guys can get a look at what the field looks like when we're spudding. So I think that'll be good for your listeners or your viewers. I think they would enjoy that, and we certainly would enjoy doing it.
100%. Well, Paul, thank you very much for your time as always.
All righty, good to speak to you guys. Appreciate it.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at StockBoxMedia.com. Thank you for watching.